Hello and welcome everyone. This is Professor Siddharth Surana. I hope you guys are doing good. मैं तो हमेशा मस्ती रहता हूँ. Welcome to Part 1, Lecture 1 on Revision cum Amendments. So revision as well as amendments applicable for CA Final May 25 and November 25 attempt and CA Inter May 25, September 25 and January 26 attempt. All the details of these lectures that I am starting from today were already announced in a separate video which is available on the channel. So once you go through that 20-minute video, you will come to know which book I am using, how we are covering inter as well as final, revision as well as amendments in the same set of lectures, and every other detail where you can get the remaining parts. For example, this first part of the lecture I am uploading on YouTube. However, all the subsequent parts of the lectures will be available only and only on our app. So all the details are already available in that separate video. We will not waste time in discussing all this and directly start with your revision cum amendments. First chapter that we have in CA Final, that is Introduction to Income Tax, is also that chapter where I complete the tax rates applicable for the assessment year. In the first chapter itself, we finish the tax rate. So let us see what do we have, because these tax rates for new regime as well as old regime with the amendments are also relevant at CA Intermediate. As we are aware, person will be divided into 7 categories. So we have individual, HUF, firm, company, AOP, BOI, local authority, artificial juridical person. All of them, if they have income, they will have to pay tax. We are learning tax rates which are applicable for previous year 24-25, that is assessment year 25-26. For of course CA Final, it is going to apply for May 25 and November 25 attempt. But if we talk about inter, of course these lectures will also be applicable for September 25 and January 26 exams, as you are very well aware. First and foremost, we are going to go and learn the tax rates of individual, HUF, AOP, BOI, artificial juridical person. First thing that we will learn, individual, HUF, AOP, BOI, artificial juridical person. As you are aware that the tax rates of these assessees are going to remain same. They all fall under slab rates, and therefore what are they? What are the tax rates? First of all, tax rates applicable for resident individual who is less than 60 years. So any individual who is 0 to 59 years, these slabs will apply. Any non-resident, irrespective of age, these slabs will apply, because you are aware, while we give benefit to senior citizen and very senior citizen, that is only and only if they are resident. So non-residents always fall with category A individual. Further, HUF, AOP, BOI and artificial juridical person also, the same slabs are going to be applicable. So when we do individuals in 3 categories, category A, category B and category C, the first category is 0 to 59 years. Second category is 60 and above, 60 to 79. Third category is 80 and above. But that second and third category is only if resident senior citizen and resident super senior citizen. So with the first category, we have all non-resident, and not just individual. HUF, AOP, BOI and artificial juridical person also have the same slabs. We are first learning the old regime. We will go through the old regime, then we will talk about the new regime. First, 2,50,000 basic exemption, 0%, no tax. From 250 to 5 lakh, on this 250 ka slab, you will have tax of 5%. From 5 lakh to 10 lakh, on this 5 lakh slab, you will have tax of 20%. And then anything above 10 lakh will be taxable at a rate of 30%. The shortcut of calculation therefore is, here you have 0 tax, here you have 12,500 tax, here you have 1 lakh rupees as your tax. Accordingly, we always calculate like this: net taxable total income minus 10 lakh, because this is the excess over 10 lakh. We apply 30% on this, and we apply the fixed tax of 1,12,500, because that is the fixed tax. Till income threshold of 10 lakh, there will be tax of 1,12,500, and for anything above 10 lakh, we will apply 30%. These are basic tax rates for various assessees. This is basic tax rate for individual of 0 to 59 years. This is basic tax rate of non-resident of any age. HUF, AOP, BOI, artificial juridical person will all come here. But these are rates in the old regime. New regime we will discuss later. Within the old regime, if you are a senior citizen, that is exact 60 to 79. 60 to 79. Here we cover 0 to 59. So in senior citizen, you will come if you are 60 to 79, but only and only if you are a resident. If you are a non-resident, you are not going to come here. You will go in the first category itself. This 60 ka age you don't have to cross, you have to only touch, because equal to will also be covered, and this you can do at any time during the previous year. So it can happen till 31st March of the previous year also, if it is your 60th birthday, or 1st April of assessment year is your 60th birthday. So full previous year you were 59. On 1st April of assessment year you have turned 60. Your birthday comes on 1st April. Still we will give you slabs of senior citizen, where the change will be your basic exemption will be increased from 250 to 3 lakh, but after that it is all same. So from 3 lakh to 5 lakh it is going to be 5%. So this time in this bracket we will have tax of only rupees 10,000. Why, sir? Last time in this bracket we had income of 250. This time we have income only of 2 lakh, and that 2 lakh is getting taxed at 5%. So we have 10,000. This 5 lakh at 20% remains same. So we have 1 lakh here, and anything after 10 lakh we have the same tax. So the only change is basic exemption will change from 250 to 3 lakh if you are 60 to 79, 60 to 79, but resident. This 60 you don't have to cross, you have to only touch. You have to touch, and this touching can happen at any time during the previous year or 1st April of the assessment year. The shortcut of calculation thus will be net taxable total income minus 10 lakh into 30%. So this is your excess over 10 lakh plus the fixed amount of tax till 10 lakh, that is 1 lakh and 10,000 rupees. 1 lakh 10,000 is fixed, and the excess will be taxable at a rate of 30%. In the old regime, for individuals there is yet another category. If you are 80 years and above, exact 80 will also be covered here. 80 and above. Once again, only and only if you are a resident. We call them resident super senior citizen, where we will give you further basic exemption limit. You will not be having any tax up to income of rupees 5 lakh. So for basic exemption for category 1 is 250, which is also applicable for non-residents, which is also applicable for HUF, AOP, BOI, AJP. Basic exemption for category 2 individual is 3 lakh, and basic exemption for category 3 individual is 5 lakh. However, for falling in category 2 and 3, you have to be a resident. Category 2 will cover 60 to 79. Category 3 will cover 80 and above. This 60 or 80, you don't have to cross, you have to touch, because equal to is covered, and that you can touch at any time during the year, or even 1st April of your assessment year. If that is also your 60th or 80th birthday, you will get your category benefit, and the rest is same after 5 lakh till 10 lakh. So you have 1 lakh rupees tax again in this bracket, and after 10 lakh everything will be taxable at a rate of 30%. The shortcut therefore in this case being net taxable total income minus 10 lakh into 30%. So that's the excess over 10 lakh plus the amount of tax which is fixed at 10 lakh, 1 lakh. In short, it is NTTI minus 10 lakh will give you excess. Apply 30%, that will give you tax on the income above 10 lakh, and then add the fixed amount of tax. For the first category it is 1,12,500. For the second category it is 1,10,000, and for the third category it is 1 lakh. This is how you are going to calculate tax in the old regime for individual, HUF, AOP, BOI, artificial juridical person. However, following things you are aware: one, these slabs that we are applying are applicable only and only for your incomes taxable at normal rates. There are certain incomes which will be taxable at special rates. This is chapter 12 of the Income Tax Act. In intermediate, you have only 4 sections from this: 111A, short-term capital gain stock market; 112A, long-term capital gain stock market; 112, all other long-term capital gain; and 115BB, that is casual winnings. Inter syllabus is only this much, but final syllabus, as you are aware, chapter 12 is very big. It's a big range of section from 110 to 115 BBJ. All the incomes that are taxable at special rate will be taught to you separately. In such cases, what do you have to do? You have to take your net taxable total income, divide it into 2 parts. The special income will be taxable at special rate, and the normal income will be taxable at normal rate. So normal income normal rate, special income special rate. The total of them is going to become your basic tax. The total is your basic tax, because after we calculate basic tax, we still have to go and learn 3 important concepts, that is rebate, surcharge, and cess. Let us go and have discussion of rebate. First, we talk about the old regime. Rebate means we are going to reduce this amount from our tax liability, subtract from tax. This is not exemption deduction. Exemption deduction gets subtracted from income, but rebate will be subtracted from your tax liability. In order to be eligible for rebate, you have to fulfill three conditions. You have to be a resident, you have to be individual, and your net taxable total income, NTTI, should be less than or equal to 5 lakh, less than or equal to 5 lakh. Resident individual income up to 5 lakh. Resident individual income up to 5 lakh, because equal to is also eligible. Anybody having income up to rupees 5 lakh will get a rebate of what? Actual tax, which you have calculated as per above rates. It will be tax as per normal, tax as per special, the total of that actual tax, or 12,500, whichever is lower. Actual tax or 12,500, whichever is lower. But as you are aware that there will be no rebate against the tax that you have calculated under section 112A, long term capital gain stock market ka tax. But of course, later when we will discuss capital gains, at that time we will be talking about it. Every student, whether inter student or final student, has to take that part of these amendment and revision lectures very, very seriously, because capital gain is that part where maximum amendments have taken place, at least for inter. New regime rates also have changed, and at final there are other chapters also, assessment of such cases, etc. Plenty of changes, but capital gain ka amendment applicable at inter final both. So we will be discussing these amendments properly, how rate of 112A has changed, how it is no longer 10%, it is 12.5, from which date it is applicable. But one thing please understand, the tax that we calculate under section 112A, against that tax we are not going to be eligible for any kind of rebate. No rebate against the tax that you have calculated under section 112A. So three conditions to get rebate: resident individual income up to 5 lakh, resident individual income up to 5 lakh. And how much rebate will you get? Actual tax or 12,500, whichever is lower. Calculate actual tax as per above rates, normal rate or special rate, and from that subtract 12,500. But if you have calculated tax in this section, from that tax you will not be able to subtract any rebate. That is your concept called rebate, which will come of course after basic tax. See, all the concepts, rebate, surcharge or cess, whatever is applicable. Cess is always applicable, rebate is applicable based on these conditions, surcharge also applicable if your income crosses a certain threshold. One thing is common, that first thing that you will do is basic tax. All this discussion will take place only after your calculation of basic tax is over. Now let's talk about surcharge. Surcharge is applicable for individual, HUF, AOP, BOI, AJP, all of them. Surcharge is later applicable for companies and firms also. So that way you can say surcharge is applicable for all the assessees, only their rates are same. So we are learning together. But rebate, as you can see, is applicable only and only for individual. Rebate is applicable only for individual, in fact only resident individual. But surcharge is applicable for all assessees. First we will learn rates of surcharge for individual, HUF, AOP, BOI, AJP, because their surcharge rates are same. Individual, HUF, AOP, BOI, AJP. If your net taxable total income is greater than 50 lakh but less than or equal to 1 crore, for example 80 lakhs, then you will be having 10% surcharge. Exact 1 crore also 10% surcharge. Greater than 1 crore and up to 2 crore, for example 1.5 crore, then you will have 15% surcharge. Greater than 2 crore but up to 5 crore, for example 2.5 crore, 3.5 crore, 4.5 crore, then your surcharge will be 25%. And if you cross 5 crore, your income is say 5.5 crore, 6 crore, 7 crore, 8 crore, 10 crore, upper side it can be anything, you will be having surcharge of 37%. Or let me put it this way, 0 to 50 lakh income, exact 50 lakh, no surcharge. Check this, greater hai. Greater than 50 lakh to exact 1 crore, equal to 1 crore, 10%. Greater than 1 crore to equal to 2 crore, 15%. Greater than 2 crore to equal to 5 crore, 25%. And greater than 5 crore, then you will be having 37%. These are the various rates of surcharge and common for this set of assessees. These are the various rates of surcharge that will be applicable. Whether you apply 10% or 15% or 25% or 37%, all this surcharge will apply on your basic tax. So your first step is going to be calculate your basic tax. On that tax amount, you have to apply 10%, 15%, 25 or 37, whichever is applicable based on the total income of the assessee. Based on the total income of the assessee, you decide whether you have to apply 10, 15, 25 or 37, and you apply that on the basic tax. When 25 and 37 was introduced, a controversy erupted that this is very, very high. Please understand. First of all, if my income is in this circle, that means I am already in basic tax of 30%. You understand? Anybody coming in surcharge means your basic tax is already 30. Basic tax becomes 30 the moment you cross 10 lakh rupees. And after that 30, if you apply such high rate of surcharge, 25%, 37%, the overall effective rate of tax becomes very, very high. And then, therefore, certain relaxations were granted. It was declared by the government some years ago that if you have any of these 5 incomes, so 5 are applicable at CA final, this one part is not applicable to inter, but the remaining 4 are applicable for inter also. Inter people are taught, inter students are taught, 4 special incomes, 25, 37 not applicable, and final students we say 5 special incomes, 25, 37 not applicable. What are the 4 incomes for inter? If you have earned dividend income, if you have earned short-term capital gain on stock market 111A, long-term capital gain on stock market 112A, any other long-term capital gain 112, these 4 incomes, or one extra part for CA final students 115 AD, long-term capital gains earned by FIIs, foreign institutional investors. If you are falling in 25% or 37%, still on these incomes we will not be applying 25 or 37%. For example, my stock market capital gain, short term or long term, or this long term capital gain, or my dividend income, I have earned 10 crore rupees. Now, when we see 10 crore, that means it has to be 37. But on these incomes, 37 will not apply. In other words, on these incomes, the maximum surcharge that will be 15%. On these incomes, 25 and 37 will not be applicable. On these incomes, 25 and 37 will not be applicable, which simply means that on these incomes, the maximum surcharge will be 15%. 25 and 37 surcharge is not going to be applicable for these 5 special incomes. Dividend income 111A, short-term stock market 112A, long-term stock market 112, all other long-term, and capital gain of FIIs 25 and 37 will not be applicable. Highest rate of surcharge is going to be 15%. So, even if your net taxable total income is more than rupees 2 crore, surcharge of 15% will be applicable on the tax that is calculated on these incomes. Why, sir? Because 25 and 37 is not applicable. Further, this is important. This is complicated. Please pay attention. If on the exclusion of these incomes, the NTTI is 2 crore or less, means your other income, see, you will be having these incomes in your total, and you will be having other income also, like salary, like house property, like any normal PGBP, like any normal IFOS. If that other income is not crossing 2 crores, then on that part also we will apply 15%. 15% will apply on the entire basic tax liability. Simply put, understand this sentence. Whatever be these incomes, the surcharge will be maximum 15%. 25 and 37 will not come. 25 and 37 will come only on your other income. So, my salary is 3 crore rupees and these incomes are 10 crore. So, total income is 13 crore. That way 37% surcharge should come. But on this part, only 15 will come, and on that 3 crore, is that 3 crore between 2 and 5? Then we will apply 25%. If my salary was 6 crore, then only on that much part we will apply 37%. So, in other words, the sentence goes like this: for 25 and 37, your other income, your normal income should cross 2 crore rupees, then 25, 37 will come only on that much part. If this part is crossing 2 crore, it will still not have 25, 37, it will be highest 15. But if the other income crosses to 2 crore rupees, then only on that other income part, 25 or 37 will come. And if that other income does not cross 2 crore, for example, these incomes are 10 crore, 10 crore special, and other income is only 1 crore. So, this other income is not crossing 2 crore, no? Then on the entire part, we will apply 15%. Of course, surcharge does not come on income. We will calculate tax on this income, and then on that tax, we will apply surcharge. Surcharge is a percentage of basic tax that I have already told you here. Surcharge is never applicable on income. Calculate tax on that tax maximum 15. If this other income had crossed 2 crore, if this other income here supposingly was 3 crore, then the total is 13. Then on this much part, calculate the basic tax and apply 15% surcharge. But on this part, calculate the basic tax and apply 25% surcharge. In other words, on these special incomes, 2537 will never apply. 2537 will never apply, means maximum surcharge will be 15%. And on the other incomes, 2537 will apply, but that other income has to cross 2 crore. If the other income does not cross 2 crore, then that income will also come in maximum 15. It can be 0, 10, 15, whatever. But 2537 cannot apply. Or final conclusion, listen to this. Is 25 and 37 applicable? When income crosses 2 crore, then 25. When income crosses 5 crore, then 37. After 2 crore, 25. After 5 crore, 37. This applies to your other income. Your other income should cross 2 crore. Then only it is going to be applicable. Otherwise, it is not going to be applicable. 2537 is not going to be applicable. That's the first part of surcharge. If there is an AOP which has only company members, an association of person where all the members are only company, for example, association of pharmaceutical companies, all members are limited companies, then highest surcharge will be 15. That means here also 25 and 37 is not going to be applicable. Then from surcharge, we are aware that we get something called marginal relief. When you cross your surcharge threshold by a small margin, still surcharge comes. The moment it is greater than the threshold, equal to does not attract surcharge, but greater than attracts surcharge. So remember this one sentence, write it down somewhere, because this one sentence is the crux, is the explanation of marginal relief. The difference in tax cannot be more than the difference in income. Write it down somewhere, write it down please. Slowly I am repeating. The difference in tax cannot be more than the difference in income. I repeat one more time. The difference in tax cannot be more than difference in income is that one sentence in which we can explain marginal relief. But let us understand how it works. Supposingly there is one person whose NTTI is exact 1 crore and another person whose NTTI is 1 crore and 5,000. So do you realize this person will come in 10% surcharge because it is greater than 50 lakh equal to 1 crore, and this person will come in 15% surcharge. However, our first task will be calculate basic tax. So on 1 crore rupees, the basic tax will be 28 lakh 12,500. On 1 crore 5,000, the basic tax will be 28 lakh and 14,000. So that difference of 5,000, if you apply 30% of 5,000, you will get 1,500 rupees, which is clearly visible in the difference in the tax. But after basic tax, we will apply surcharge. So in the first case, we will apply 10% surcharge, and in the second case, we will apply 15% surcharge, which makes this your basic tax plus surcharge. Basic tax plus surcharge. Now understand, the difference in the income between these two people is only 5,000, 5,000, 5,000. If I call this person A and I call this person B, B has earned only 5,000 more than A. B has earned only 5,000 more than A. Correct hai ki nahi? But the difference in their tax is coming to 1,42,350 rupees. Difference in income is only 5,000 and difference in tax is 1,42,350. If I just conceal this 5,000 income, I don't declare this 5,000, then my tax will be same as this guy. That is stupid. And therefore the sentence. Now read what you have written. The difference in tax cannot be more than difference in income. The maximum difference will be 5,000. If income difference is 5,000, then tax difference will also be 5,000. If this is 30,93,000, this will be maximum 30,98,000. And whatever is the difference that we are going to eliminate from this calculation by calling it marginal relief. The difference will be eliminated by calling it marginal relief, and after getting marginal relief, the tax will be 30,98. Basically, this tax plus 5,000. This tax plus 5,000 is going to be the tax. The difference in tax cannot be more than the difference in income. This is how we have calculated the tax of individual, HUF, AOP, BOI, AJP in the old regime, basic tax with surcharge and rebate also. Rebate 3 conditions: resident, individual, income up to 5 lakh. Surcharge only and only one condition: whether you are resident or non-resident, surcharge comes for all. Whether you are individual, HUF, AOP, BOI, AJP, in fact company firm also, they have different rates but they have surcharge. Rebate is only for individual, surcharge is for all assessees. Rebate is only for resident, surcharge is for resident, non-resident all. For rebate, your income has to be less than or equal to 5 lakh. For surcharge, your income has to be greater than 50 lakh. So rebate or surcharge may or may not apply depending upon income range. But then we have this last concept, the concept of HEC, that is Health and Education Cess. HEC, that is Health and Education Cess, will be applicable always, whether you are a rebate case, whether you are a surcharge case, whether you are rich or poor, no matter who you are, HEC will be always applicable. Step number 1, calculate basic tax, subtract rebate if applicable, add surcharge if applicable. Of course, between rebate and surcharge, you should know that they can never coexist, they can never come together. Rebate or surcharge, only one of them can be applicable at one point of time. So check which one of them is applicable and apply 4% of that. 4% of your basic tax minus rebate plus surcharge. It can be only basic tax, it can be basic minus rebate, it can be basic plus surcharge. Apply 4%. In all cases, no matter who you are, 4% health and education cess will be applicable. This is how, ladies and gentlemen, we are going to be calculating tax for individual, HUF, AOP, BOI and AJP. Individual, HUF, AOP, BOI, AJP in the old regime. But for these assessees, we also have the new taxation regime as per section 115 BAC. We have new taxation regime. We also have 115 BAA, BAB, but that is for companies. We will discuss that with companies. We'll discuss company old rate, company new rate. We also have BAD, BAE, BAD, BAE, that is for cooperative societies. We will discuss cooperative society also, old regime as well as new regime. But we have just now completed old regime of individual, HUF, AOP, BOI, AJP. Let's go and see what is new regime. For them, we have 115 BAC. So totally we have 5 sections of new regime: BAA, BAB, BAC, BAD, BAE. Ba, Bab, Bas, Bad, Bay. Ba, Bab, Bas, Bad, Bay. Out of these 5, companies we will do later, BAA, BAB. Cooperative society we will do later. We are doing 115 BAC, which is applicable for individual, HUF, AOP, BOI, AJP. The rates have once again changed. So the basic rates here are different. When first time they were introduced, each slab was 250, 250, 250, 250, 250 each. Then after an amendment which took place only last year, all the slabs became 3 lakh. It was 0 to 3, 3 to 6, 6 to 9, 9 to 10. Still easy. The worst part of people giving exam in your year, so CA final May 25, November 25 and CA inter May 25, September 25, Jan 26, that the slabs have different amounts. In fact, next year onwards also, if you want to know, though it is not relevant for you, but next year when the budget of 25 will be applicable, your budget is 24. Next year when 25 budget will be applicable, every bracket here is 4 lakhs. So before you it was everything 3 lakh, after you it was everything 4 lakh. You all are unlucky children of destiny. Very, very unlucky, but all the unlucky things are happening with you only. Complicated slabs, complicated capital gain. You all are the only people in history who will learn old capital gain as well as new capital gain, because amendments are effective from middle of the year. So you need to know old law as well as new law. People before you are very lucky, people after you are very lucky. So after this lecture gets over, you can go home and fight. Either people at your home were too early to bring you or too late to bring you. If you were 1 year before or after, so things wouldn't have been as difficult for you, but can't help it. Now you have to give the exam, especially if May 25 is your attempt. You can't be dreaming of postponing it to May 26. Bro, chill kar thoda sa. Isse better hai ki you put some effort here only. So in the new regime, for all the assessees, so we will now not make any distinction in senior citizen, super senior citizen, individuals of all categories, HUF of all categories, AOP, BOI, AJP, all of them, individual HUF, AOP, BOI, all individual HUF, AOP, BOI. Basic exemption will be 3 lakh rupees. 0 to 3 lakh, there will be no tax. Then 3 lakh to 7 lakh. So the amendment here is, last year it was 3 to 6. Now it is 3 lakh to 7 lakh. So we have 4 lakh rupees falling in this bracket, taxable at 5%. This bracket will give you tax of 20,000 rupees. Then 7 lakh to 10 lakh. So this remains 3 lakh. Last year it was 6 to 9. Now it is 7 to 10. It will be 10%. So the tax that you will get here is 30,000. 10 lakh to 12 lakh. Now this bracket reduces. Last time it was 3 lakh rupees falling in 15%. Now we are left with only 2 because 1 lakh extra we have already put here. So only 2 lakh rupees will be taxable at 15%, giving you 30,000 rupees. This still remains same. We have 3 lakh rupees taxable at 20%. So we'll give you 60,000 rupees here, and anything after 15 lakh will be taxable at 30%. As we are aware that in the new regime, we have fixed tax till 15 lakh. In the old regime, we have fixed tax till 10 lakh. That also you have to learn 3 different figures: 1 lakh 12,500, 1 lakh 10,000 and 1 lakh, because 3 different categories of individual. But in the new regime, it is all same for everyone. At 15 lakh rupees, your tax is going to be, ladies and gentlemen, 1 lakh 40,000 rupees. At 15 lakh, your tax will be 1 lakh 40,000 rupees, and anything after 15 lakh will be taxable at 30%. So if you want to bring a shortcut here, net taxable total income minus 15 lakh, this will give you the excess over 15 lakh. You will be applying 30% on this, and you will add 1 lakh 40,000 to this. Net taxable total income minus 15 lakh into 30% plus 1 lakh 40,000. At 15 lakh rupees, you have fixed tax of 1 lakh 40,000 rupees. Last year, this was coming to 1 lakh 50,000. So on the basis of all the amendments that they have done here, your savings are only rupees 10,000. And if we compare with old regime, you know, in old regime, if you want to compare, in old regime, at 15 lakh, you can apply the slabs. 5 lakh into 30% plus 1 lakh 12,500. In old regime, you will get 262,500. Old regime, you will get how much? 262,500. Last year also it was same, because old regime, if you have observed, there is no change, absolutely no change. It is lying in the corner. In India, I call it bhangar. Bhangar ki tarah corner mein pada hai. Nobody is even interested in it. Nobody is even talking about it. Nobody is even touching it. 262,500. Till last year, this fixed tax at 15 lakh in the new regime was 150. So the difference was 1 lakh 12,500. The only savings was 1 lakh 12,500. Yes, I do agree. Now you have additional 10,000 saving. So the difference between old regime and new regime now is going to be 1 lakh 22,500. New regime, if at all, will save tax for you. New regime, if at all it saves tax for you, it will save, ladies and gentlemen, 1 lakh 22,500 rupees. And you have no idea what all it is going to take away from you, only for saving that 1 lakh 22,500. I believe you do have idea. These are amendment cum revision lectures. These lectures are absolutely not meant for anybody who is learning tax for the first time. If you are learning for the first time, these lectures will appear like French, Greek and Latin to you. Obviously, you won't understand anything. Okay? These lectures are amendment revision lectures, so obviously you have basic idea about the subject. Then only you can learn the syllabus now in these 10-15 hours that I will complete your amendment and revision. So last year the saving was 1 lakh 12,500. Now the saving is 1 lakh 22,500 rupees. Then this is again basic tax. You are aware in new regime also special rate will apply. So again we will segregate special income, special rate. Only normal income will come in the slabs that are given here, but there is going to be rebate here also. What is the difference? Condition 1, you still have to be resident. Condition 2, this is still individual, but this time your net taxable total income can be up to rupees 7 lakh. Up to rupees 7 lakh. So in old regime, you get rebate only and only if your income is up to 5 lakh. But in new regime, you will get rebate up to 7 lakh. Bro, listen. If in new regime, my income is 7 lakh and I only utilize 80C and 80D deduction to its full capability, 1 lakh 50,000 and 50,000, then my old ka income will become 5 lakh and I will be eligible for rebate. So the difference of this 2 lakh is a bloody scam. we have to forego innumerable exemptions and deductions to be eligible for or to be entering the new regime. So that way, as you are aware, it's a complete scam. But yes, in old regime, rebate eligibility is at 5 lakh. In new regime, rebate eligibility is at 7 lakh. So old regime, resident individual income up to 5 lakh. New regime, resident individual income up to 7 lakh. And what will be your rebate? Here it will be actual tax or 25,000, whichever is lower. One more benefit here. Here we will give you marginal relief also if your NTTI marginally exceeds 7 lakh. For example, your NTTI is 7 lakh 10,000 rupees. Normally, we don't get any marginal relief in basic tax. Marginal relief is only a part of surcharge calculation. But if my NTTI is 7 lakh and 10,000 rupees, so I will not get my rebate. So there is going to be full tax on the basis of these slabs. So the difference in tax cannot be more than 10,000 because my income has exceeded only by rupees 10,000. My tax cannot exceed by more than 10,000. Marginal relief, still that same sentence which I made you write, difference in tax cannot be more than difference in income. At 7 lakh, my tax will become 0 because I will get rebate. But at 7 lakh 10,000, I will be having full tax, which can be more than 10,000 also, which is not fair because my income has exceeded only by rupees 10,000. So my tax will also be only 10,000. There will be tax, but the difference in income, the difference in tax cannot be more than the difference in income. So yes, this is your concept of rebate. Rebate under section 87A applicable for new regime. And one more time I would like to remind you, 112A tax, there is no rebate. I know the CA final students are over confused about 111A. We already have the Bombay High Court decision. Now please don't panic. See, 2025 budget, which is not applicable for any of you all. 2025 budget will apply for next year students. In that budget, now government has openly said any income taxable at special rate, there will be no rebate. But don't unnecessarily confuse yourself. In your syllabus, there is only one income against which there is no rebate, and that is 112A, long-term capital gain stock market. All other incomes, including short-term stock market, will be eligible for your rebate. Next year onwards, they are putting the discussion to a complete end. Now, some of these memes, for example, this. This is the last 5 years and the next 5 years of CAs, middle class, CA students, economy, all other memes. I told you, buy the book, watch the memes. The lectures are not for entertaining you. Entertainment is a byproduct. Lectures are for educating you, but because it's a boring and dry subject, so while reading the book, you should get some excitement, some entertainment, which is why we have incorporated your memes here. I hope you go through them once you take the. I have told all of you all final students, so once you enroll for the regular batch, we give this book as a part of the batch. We give the full set of 5, but inter students also I recommend that you, believe me, your revision is going to be very, 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 very fast if you have this book. I don't normally force students. I just say that it will be good because I don't want to sound greedy. You really please understand that you buying one book is not going to contribute anything great in my life. It is going to contribute in your life only. That day when you understand that thousands of students are buying it and getting good marks with that, you will realize that I am not telling you to buy this book for myself. I am only getting the cost of the book and I am delivering the book to your house. It is you who are earning something out of it. So choice is yours. But if somebody who believes in me is asking me, sir, should I take? So I always say yes, you should go for it. Yes. So in new regime, what about now surcharge? Surcharge will be applicable as it is, but 37% surcharge is removed. So new regime surcharge is only 10, 15, 25. The thresholds are all going to be same. The rates also same, but as we are aware, the income calculation in new regime is different. This income will be without exemption and deduction. So we will take NTTI as per the new regime and apply the surcharge as it is. Cess is also going to apply absolutely same. Special rates of tax will also apply absolutely same. So again, we have to segregate. All the things that apply in the old regime will apply. Just two things. One, 37% surcharge is not applicable. And second, a hidden benefit of new regime. Alternate minimum tax, because we are talking about individual HUF, AOP, BOI, AJP, we talk about AMT. Later we talk about companies, there we will say MAT will not be applicable. Yes, in new regime, MAT, AMT get abolished. AMT will not be applicable for these assessees, and for companies, minimum alternate tax, MAT will not be applicable. MAT will not be applicable. So surcharge will be applicable, but only till 25, 37 not applicable. Cess, thankfully, across regimes, across assessees, in all the cases, cess is only and only your 4% on your total, and special rate will apply, AMT will not apply. One big change that took place last year, so it is not an amendment, now it works only as a revision. 115 BAC, that is new regime, will be default regime. You have the option of old and new. If you don't decide anything on or before the due date of return filing, by default you will be put in the new regime. So you have to choose the option of going to old regime. You have to tell them that I want to go in the old regime, and that you have to do on or before due date of return filing 139. So let's be clear. If I don't do anything, new regime, and if I say I want old, then only I will get old. In income tax, they give two options, old regime and new regime. My clients, I give two options, old regime or poison. You are aware, no? Those who have attended the full course lectures. So as of now, for 120 to 500, I am not moving to the new regime. I will remain in the old regime. But if I don't do anything before due date of return filing, then they will put me under new. So if I want to stay in old, I have to exercise my option. If I don't have income from business profession, I can exercise the option year on year basis. Every year I can choose. By default, I am in new regime. I can choose the option of old regime. I can every year change old, new, old, new, old, new, old, new, old, new. Every year I can change. But if I have income under business profession, in my case I do. So first of all, by default, I am in new regime. I can exercise the option and go to the old regime. Now where am I? Old, old, old. Now I can change one. So when I say exercise, means I have gone from new to old. Now where am I? Old, old, old. Now I want to come back to new. Am I allowed to come back to new? Yes, I will be allowed to come back to new. I can go from new to old. By default, where am I? By default, where am I? By default, new. I can go from new to old. I can come back, but only once. Now I will not be getting old regime ever again in life, unless if I stop having PGBP, I fall in this category. So this category, as we can see, can exercise the option on a year on year basis. If I fall in this category, it will be year on year basis. Otherwise, I can go from new to old. I can come back from old to new, but second time I can't go. So those who don't have income under business profession, they can change year on year basis. Those who have income under business profession, they can go from new to old, come back from old to new, but now they can't go back to old unless they stop having PGBP. These are the features of the new taxation regime. Of course, rates have undergone change. Now the tax benefits to be foregone. Bhari hai bro, bhari. If you overall compute the net effect of the tax benefits that you are going to lose, you will really find 1,22,500 not worth it. Let's see. Section 10(5) leave travel allowance, which is given under salary. Salaried employees get LTA and then they travel. So the tickets that they purchase, they get exemption only in the old regime. So please understand, these are tax benefits because they are exemption or deduction. If you want to avail the option of 115 BAC, if you want to avail the option, that is, you want to go in new regime, if you want to save 1,22,500 rupees, so you won't get the following exemptions. In other words, following exemptions will be given only and only in the old regime. Leave travel allowance, house rent allowance ka exemption only in the old regime. Under section 10(14) in salary, we have some salary, house, property are now removed from CA final. So a lot of people may not have knowledge of it, may have forgotten by now, but I'll tell you, children education allowance, children hostel allowance, we have some exemption for that. We won't get those exemptions, but there are exceptions. Matlab, these are going to be allowed even in new regime. What is this list? 1 to 20 exemptions or deductions which are allowed only in the old regime. But if there is an exception, means this part will be allowed even in the new regime. Transport allowance for handicapped Divyang employee, conveyance allowance to perform office duties, tour travel transfer allowance, daily allowance for absence from normal place of duty. These exemptions will be allowed even in the new regime. Otherwise, other exemptions not allowed. When you are member of parliament or MLA, you get something called daily allowance or constituency allowance, which is exempt only in the old regime. New regime, it will be taxable. When income of minor child is club, then parents get exemption. Amount club or 1,500 per annum per child, whichever is lower. That exemption will be only in the old regime, not allowed in the new regime. Under special economic zone, we get deduction. First 5 years 100% of qualifying amount, next 5 years 50% of qualifying amount, last 5 years, which is applicable only for CA, final 50% of qualifying amount or amount transferred to SEZ reinvestment reserve, whichever is lower, subject to lot of conditions, only in the old regime. Now be very careful here, because of big amendment, especially inter students, your salary income calculation will depend on this. Big amendment this is. Okay, and final students also note this carefully, because after clearing these exams, you are going to go for, if you are going for a job, so it is going to directly affect your income calculation. The deduction under 16.2 and 16.3. So under section 16 in salary, we get 3 deductions. We have 16.1A standard deduction. We have 16.2 and 16.3 professional tax paid. 16.2 is entertainment allowance and 16.3 is professional tax paid. Entertainment allowance ka deduction is given only to government employees, and professional tax paid is given to all employees provided it is paid, only and only if it is paid. These 2 deductions will not be allowed in the new regime. That means entertainment allowance and professional tax paid ka deduction will be allowed only and only in the old regime, which means standard deduction will be allowed in the new regime. I'll tell you the history. When new regime first time came, old regime we know standard deduction of 50,000 rupees. We are all aware of that. When new regime came for the first time, they said standard deduction not allowed in the new regime. Not allowed only. Because in new regime you have to forego benefits. But people were not taking new regime. So last year only they brought a change. They said that there will be standard deduction in new regime also. That means you can take 50,000 in old as well as new. That means for standard deduction both became same. Till last year, check all those who gave the last year ka exam, you were giving 50,000 deduction in old as well as new regime. Now they want to make the new regime look more attractive. Listen, mark my words. Not make the regime attractive. New regime is not attractive. It is only looking attractive. There is a difference between looking attractive and being attractive. There is a difference between looking attractive and being attractive. I know I am both. But new regime only looks attractive. It is actually not attractive. They have only to make it look attractive. Now they say what? In new regime, first of all, standard deduction will be allowed. So standard deduction, old regime 50,000. In new regime, higher standard deduction will be given. That is actual salary or 75,000, whichever is lower. In other words, in old regime, your standard deduction is 50,000. In new regime, first it was not allowed, then they made it 50, now they make it higher. New regime, you are going to get standard deduction of 75,000 rupees, higher than old regime. And plus one more thing, now because it is no longer a part of this list, I have just kept it because this is also very important amendment. We have an income called family pension under income from other sources. When employee dies and spouse gets pension, that's IFOS, the spouse gets a deduction. 1/3 of that amount or 15,000 per annum, whichever is lower. 1/3 of family pension or 15,000, whichever is lower. Is that a deduction in IFOS? When new regime came first time, they said not allowed. Then they amended and said allowed. And now they again amend and they say higher allowed. That means for both standard deduction and family pension deduction, standard deduction and family pension deduction, what have they done over the years? First, they were not allowed only in the new regime. Then they made it same as old. That means standard deduction of salary 50,000 and family pension deduction 1/3 or 15,000, whichever is low. And now they are increasing in the new regime. So in the new regime, now standard deduction. Let's compare. Old regime standard deduction of salary 50,000, new regime standard deduction of salary 75,000. And family pension deduction. Old regime 1/3 or 15,000, whichever is lower. New regime 1/3 or 25,000, whichever is lower. 1/3 or 15,000 in the old regime, whichever is lower, and in the new regime 1/3 or 25,000, whichever is lower. This is how they are giving higher benefit in the new regime. So now the new regime is very attractive, no? 1,22,500 rupees. Remember this. Not everyone has family pension. And the extra that you are getting is only 10,000 rupees in family pension. All salaried employees do have standard deduction, but the extra is only 25,000. Even if you are in 30% bracket, you are saving 7,500 rupees. Agreed. So in that 120 to 500, you add 7,500. That will make it 130. 130 is still very low compared to what all you are leaving. You want to see more? In new regime, you won't get any SOP deduction. In old regime, we get no up to 2 lakh rupees. New regime, we won't get in SOP. LOP, DLOP, we will give you. Sir, why we are giving you? Because in LOP, DLOP, you are showing income. Because you are showing income, so we don't mind giving you deduction. But in SOP, you won't be getting any deduction. In new regime, you won't get any additional depreciation. You will get only normal depreciation. So no extra benefit. Tea, coffee, rubber, site restoration, these are sections. Even final students, I tell them only to read them. These are deductions of PGBP which will be allowed only in the older regime, not allowed in the new regime. If we talk about section 35, this big point, section 35 totally has 7 subparts. 35.1.1, 35.2, 35.1.2, 1.2a, 35.1.3, 35.2AA and 2ab, total 7 parts. Out of that, 35.2ab is applicable only for companies, and we are learning 115 BAC which is applicable to individual HUF. So 35.2ab is gone. It is not applicable. Remaining 6. From the remaining 6, 35.1.1 and 35.2, that is revenue expenditure in own business scientific research, capital expense in own business scientific research. These two are going to be allowed in the new regime, but the remaining. So contribution to any scientific research association, college, university, contribution to any scientific research company doing in-house scientific research, contribution to any association for approved research, statistical or social science, and contribution to national laboratory. These 1, 2, 3, 4 things will not be allowed in the new regime. In other words, in section 35, there are totally 7 parts. One is applicable only for companies. Ignore that right now. We will talk about it in company new regime. Remaining 6. In these 6, 2 will be allowed in the new regime and the remaining 4 will be allowed. These 4 will be allowed. 1, 2, 3, 4 will be allowed only in the old regime. Next, 35 AD, investment linked deduction, 14 specified businesses. Capital expenditure, 100% deduction, only in the old regime, not allowed in the new regime. We have a section 35 CCC at CA final, agriculture extension expense. You will get 100% deduction of all your capital and revenue expenses, only in the old regime, not in the new regime. The biggest aspect or factor that is going to affect the middle class, new regime mein, ladies and gentlemen, chapter 6A deduction, not allowed, not allowed, not allowed, not allowed, subject to certain exceptions. 80 CCD2, employer contribution to NPS. So there is CCD1 also, which is own contribution. CCD1B is also own contribution. That is not going to be allowed. Only subsection 2, employer contribution, because we are including in the income. 80 CCH2, employer contribution to Agniveer fund. 100% of the contribution is allowed as a deduction. Only employer contribution. Here also we have subsection 1, own contribution. That won't be allowed. Only subsection 2, once again, because it is included in your salary. The most important of all, dear students, whether you are giving inter exam or final exam, this section you please make sure you study properly and perfectly, because over the last few years I observe almost every attempt, especially at CA final, you get this 80 JJAA, 30% of new, 30% of additional employee cost. So whenever you are engaging new workmen, you will pay them salary, 30% of their cost subject to a lot of conditions will be allowed as a deduction in old as well as new regime. Normally chapter 6 are not allowed, 80C not allowed, 80D not allowed, 80G not allowed. By the end I am going to make you eligible for 80U also, but only in the old regime. New regime not allowed. These deductions will be allowed even in the new regime. So CCD2, CCH2, JJAA, and there is one deduction again for CA final, 80LA, that IFSC wala deduction, 10 consecutive years out of first 15 years, 100% deduction, that will be allowed. There is one more 80M, but that is only for companies. So again, we can't discuss in 115 BAC. We will discuss in BAA, BAB. So these are the chapter 6 deductions that will not be allowed. All the above benefits that you are foregoing, for example, scientific research, for example, 35 AD. The year when you move to the new regime, it won't be allowed. Correct? But it is possible that in the past you were in the old regime and you took the deduction, but there was insufficient profit, so there is brought forward amount. The brought forward amount also will be gone. Supposingly last year I was in old regime, so I was eligible for 35 AD deduction. amount I took as deduction, but there was some amount which was unutilized because my profits were over. So that becomes my brought forward loss. This year I moved to the new regime. So this year ka no deduction plus brought forward also no deduction. All the benefits that we are foregoing here in the current year I will not get, and if there is any brought forward I will not get that also. If you have any house property loss, you will not be allowed to adjust that house property loss against other incomes. In old regime, house property loss is allowed to be adjusted. Set of May, it is allowed to be adjusted against other incomes except casual winnings, maximum 2 lakh rupees. But in new regime, house property loss has to be carried forward. You can't adjust against other incomes. And if you have any perquisite or allowance which is exempt under any other law. So when we say perquisite or allowance exempt under any other law, matlab any exemption given as per Payment of Gratuity Act or Industrial Dispute Act or anything like that, all those exemptions are not going to be available in the new regime, which means the new regime comes with so many things that you have to forego, that by the end you realize old regime or poison. Remember, you are only saving 1,22,500 rupees. That's your discussion of tax rates for individual HUF, AOP, BOI, AJP for old as well as new regime. We still have to learn tax rates of other assessees, that is cooperative societies, partnership firm, companies. If we talk about cooperative society in the old regime, very simple slab up to 10,000, 10%. From 10,000 to 20,000, that is the excess of only 10,000 rupees, it will be 20%. So first 10,000 ka 10% pay you already have 1,000, plus remaining 10,000 pay you will have 20%, that is 2,000. So that means in simple language, at 20,000 rupees you will be having 3,000 rupees tax. First 10,000 ka 10%, next 10,000 ka 20%. 1,000 plus 2,000, 3,000, and anything after 20,000, this will be this 3,000 plus 30%. So first 20,000, 3,000, balance 30%. Surcharge, if income is between 1 crore and 10 crore, it will be 7%. And if income is greater than, printing mistake here, if the income is greater than 10 crore, then it is going to be 12%. If income is between 1 crore and 10 crore, it will be 7%. And if it is more than 10 crore, then it is going to be 12%. Okay. Next, HEC 4% always will be applicable. For cooperative societies, there are two sections of new regime. One, we have section 115 BAD, which is applicable only for resident cooperative society. So if you observe in BAD, BAE, BAA, BAB, they have mentioned domestic company, resident cooperative society, but they did not mention anything like that in BAC. So BAC is available for individual HUF, AOP, BOI, AJP, whether you are resident or non-resident. However, companies which go in 115 BAE, which is a special section for manufacturing business, obviously will not be coming here. The basic tax rate is a flat rate of 22%. Basic tax rate is going to be flat rate of 22%. So no slabs, direct 22. On that there will be flat surcharge, always applicable surcharge of 10%. So this will not depend on your income. Irrespective of income, there will be 10% surcharge and 4% cess. Resultingly, you will be having 22 plus compulsory 10 plus compulsory 4, making your effective tax rate of 25.168%. Special rate will apply here also, and AMT will not be applicable here. We are aware MAT AMT does not apply. Only in individual ka section 115 BAC, the default regime is new and you have to exercise the option for going to old. Otherwise, here the default regime in all the other cases, that is companies or cooperative society, the default regime is going to be old. That means if you are exercising the option, you are going from old to new. By exercising the option, you are going from old to new. In individual, you are in default new, exercise option of old. Here you are in default old and exercise option of going to new. This has to be done before the due date of return filing, and once applied, it can never change. What was the rule in individual? Non-PGBP change every year, and PGBP you can come back once to new, but you can't go again. But here, once you go from old to new, you will always forever stay in new regime. You can never come back to the old regime. Tax benefits to be foregone majorly are same only as 115 BAC, but some of them which were applicable to individuals, leave travel allowance or house rent allowance, they can't come in cooperative society. So you just remove that part. So you'll get all the other as same. So SEZ deduction will not be available. additional depreciation not available. You have your tea, coffee, rubber site restoration not available. Same 4 things of scientific research. So these 2 will be allowed. This is not applicable as it applies only to company, and the remaining 4 not allowed. 35 AD investment link deduction, 35 CCC agriculture extension not allowed. Chapter 6 deduction not allowed. However, 80 JJAA and 80 LA will be allowed. See, 80 CCD2 and CCH2 are individual based. So again, we don't have to discuss them. And with respect to all the above, if there is any brought forward also, it will not be allowed. Anything brought forward also is not going to be allowed. As far as tax rates of partnership firms are concerned and tax rates of companies are concerned, in this book, because this is the CA final book, we have a dedicated chapter. We have a chapter called assessment of partnership firms for firms, and we have a chapter called minimum alternate tax for companies. So we will be discussing the details about these assessees in that chapter. We have some more memes for you, and I have to tell you a small little thing about 115 BAE. See, historically for companies there were 2 sections, 115 BAA and BAB, which we will be discussing in the MAT chapter, because companies ka full tax we will discuss there. We have 2 sections of companies in new regime, BAA and BAB. They were simultaneously introduced, and they were both for domestic companies. So question came, sir, which company this will apply, which company this will apply? At that time the announcement was all existing companies will come in this. Any company which was incorporated before 1st October 2019, because 2019 was the date when 1st October 2019 mein these 2 sections were introduced. So if you are a new company which is in manufacturing business, then for you we will have 115 BAB. So old companies will come in this 115 BAA. Non-manufacturing companies, even if you are newly incorporated, will come in this. Newly incorporated only manufacturing will come in 115 BAB. Otherwise, everyone else will go in 115 BAA. That means, simply put, new manufacturing companies, date of incorporation will be discussed later. New manufacturing companies will have, if you observe carefully, 8% benefit in their tax rate. 8%. But there are cooperative societies also doing same business, manufacturing. They said, sir, we are not getting any benefit for manufacturing, which is when last year only this new section was introduced, 115 BAE. Whatever benefit we are giving to companies here compared to BAA will be a benefit given to cooperative societies here compared to BAD. So for companies, we will have 115 BAA and 115 BAB, and for cooperative society we will have 115 BAD and 115 BAE. Correct? These 2 sections have the same assessee, domestic company. These 2 sections have the same assessee, resident cooperative society. Which is why people feel that these 2 sections are same and these 2 are same. No sir, not true. To be very honest, in these 2 only assessee is same. The real similarity is that these 2 are absolutely same. The rate is same, 25.168. Cooperative society we already saw, 115 BAD. Company we will learn later. These 2, their rate is same, 17.16. Cooperative society we see here 115 BAE, and for companies we will see in the MAT chapter. All conditions of getting the concessional rate same. Whatever conditions are written in BAB are also applicable for BAE. That means these 2 sections have more similarity. In these 2 only assessee is same, everything else is different. So whatever conditions were written in BAB are repeated in BAE. So once we do BAB in MAT chapter, you will automatically get all the conditions, and I have mentioned that here. For cooperative societies, only BAD was introduced to provide parity for newly incorporated cooperative society in the manufacturing business. Like we have newly incorporated company in the manufacturing business, to provide parity for newly incorporated cooperative society, BAE has been introduced with all conditions same as BAB. So whatever are the conditions written here are the same conditions written here, subject to the following difference. For BAB, the date of incorporation was 19 because it was introduced in 19 budget. But this BAE was introduced in 23 budget. So the new cooperative society should incorporate on or after 1st April 23. The incorporation date obviously here is different. Here under chapter 6A, only 80JJAA is going to be allowed because they are doing only manufacturing business. Only 80JJAA is going to be allowed. And 115BAB has a very stupid condition, illogical condition, nonsense condition, that if you are taking benefit of 115BAB, you should not be using any building which was earlier a hotel or a banquet, a convention center. In any case, I am in manufacturing business. If I am in manufacturing business, why will I use a hotel? It was already illogical. Last 5 years, I have been telling people that it is illogical. And this goes to further prove that it is illogical because any such mention is not done in BAE, which means under BAB also it is unnecessarily written. That means BAB and BAE are for manufacturing benefits. All the conditions are same. So when we learn BAB in math chapter, automatically you can come and understand BAE. That was your first chapter, introduction and the tax rates. Now, at this part of the lecture, the discussion that I am going to do with CA inter students in the first lecture hereby comes to an end. My second and third chapter in CA final are applicable only for CA final students. So inter students do not have to watch this lecture any further. But before you leave this lecture, just watch the last 3-4 minutes of this lecture, please. Scroll this taskbar, scroll this bar to the end of the lecture. Watch the last 3-4 minutes, because for your further lectures, how we will be going about with your revision cum amendments, I will be making it clear to you in the last 3-4 minutes. So please make sure, while you as an intermediate student can leave the lecture now, once the recording is available on YouTube, you please make sure you check the last 3-4 minutes properly so that you get clear idea about what should be your approach in the revision cum amendment lecture. As far as CA final students are concerned, you have to watch every single minute of these lectures, except when I will do salary house property, which is not applicable to you. Okay, so CA final students have to watch everything. Inter students, you have to watch what? Please check the last 4 minutes of this lecture. So with this, we get done with the first chapter, tax rates, that is introduction. Now we go ahead, second chapter in our CA final, double taxation avoidance agreement, DTAA, double taxation avoidance agreement, also known as treaty or convention. Globally, one of the most important concepts, every chapter of international tax it is going to come, and I teach this concept to CA inter students also. Globally, there are two principles of levying tax. Whichever country in the world will levy income tax, they will apply principle of residence, that is your home country, or principle of source, that is your host country. India applies this. If I am a resident, I have to pay tax on world income. Because India is my home country, it is applying principle of residence. Supposingly, I am non-resident. Even if I am non-resident, if I earn anything in India, then India will still take tax from me because it is my host country, principle of source. So home country will tax your global income on principle of residence, and host country will tax your that country's income at least on principle of source, because you earned over there. And this, ladies and gentlemen, is going to result in something called double taxation. When I am resident of one country and I have source in another country, resident in one country, source in another country, home country will apply principle of residence and host country will apply principle of source, and thus it will result in double taxation. So whenever there is any tax levied, income tax levied by any country in this world, whichever country levies income tax, except tax heavens, except those countries which have no income tax, either they will levy on principle of residence or they will levy on principle of source. How is this going to result in double taxation? Let us try and understand how double taxation is going to take place because of this. Double taxation is of two types. First, juridical double taxation, when the same person on the same income is taxed twice. Same person, same income, taxed twice. Same person, same income, taxed twice. What is juridical double taxation? Same person, same income getting taxed twice. This is where the previous concept will help you. Supposingly, a person who is resident of India has earned income in New Zealand, say 100 rupees. So, will India levy tax? Yes, because principle of residence, home country. Will New Zealand levy tax? Yes, because principle of source, host country. And thus, together, you will be paying such a massive tax. Is it the same person who is paying both? Yes. Is it the same income? Yes. And is he getting taxed twice? When the same person on the same income is getting taxed twice, when the same person on the same income is getting taxed twice, that will be called juridical double taxation. This is genuine hardship. If we don't give you relief here, then people will stop going to other countries. There will be hindrance in free flow of trade and industry. Therefore, there is going to be some relief for sure. Under juridical double taxation, we are going to definitely grant you some relief from double taxation. However, we also have a second concept of double taxation, that is economic double taxation. Here also same income tax twice, same income tax twice, same income tax twice, but two different people are paying tax. Two different people. First, we'll understand the example. A company in India pays audit fees to a chartered accountant 1 lakh in cash. First of all, is the CA getting his fees? Yes. So will the CA pay tax on the income? Yes, yes, yes. Under PGBP, he will have to show that income because professional fees. But the company will not get deduction because of cash expenditure in excess of rupees 10,000. Cash payment more than 10,000 is disallowed, 40A3. So for the company, it will be disallowed, means in the company's profit also it will be there. And that means company will also pay tax. That is economic double taxation. The same 1 lakh is getting tax for the CA as income and tax for the company because it is not getting deduction of expense. We should have subtracted, but disallowed. So when different people are paying tax on the same income, it is economic double taxation. What is juridical? Same person. What is the difference? When same person is paying, it is juridical. When different people are paying, it is economic. Otherwise, same income getting taxed twice, same income getting taxed twice, this part is common. Same income getting taxed twice is common. Under juridical, it is the same person. That means both tax liabilities, this 30 and this 40, are going from your pocket. Because both taxes are going from your pocket, we will give you relief. But check this. Do you realize that even when the same income is getting taxed twice, they are two different people, the company and the CA? That means from your pocket, tax has gone only once. And because from your pocket, tax has gone only once, there will be no relief. Relief will be granted only and only under juridical double taxation. There will be no relief under economic double taxation because from your pocket, the tax outflow has taken place only once. Only once. Relief is available when you pay both taxes, which is only under juridical. Double taxation relief will be given only under juridical double taxation. There is no relief in economic double taxation. So from now onwards, because we are talking about granting of relief, we are discussing only juridical double taxation. To protect assessee from genuine hardship, same income getting taxed twice, of juridical double taxation, there are two ways of giving relief. When both governments cooperate with each other and they enter into an agreement with each other. So DTAA is not an agreement between assessee and government. DTAA is an agreement between two governments. When both governments enter into an agreement, that agreement only will be called double taxation avoidance agreement, treaty or convention. But if there is no agreement because there is no cooperation between the two governments, then government of India will come forward to give you some relief. That relief is called unilateral relief under section 91. So when both governments are working together, as the name indicates, bilateral, and when only one government is involved, it will be called unilateral. This chapter is all about learning bilateral relief and unilateral relief. Your explanation of what is an agreement given, nothing but an agreement between two governments, and the main target is relief from double taxation, exchange of information and assistance in tax collection. Relief from double taxation, exchange of information. What is bilateral relief? Government of India can enter into DTAA with foreign governments to grant relief under cases of juridical double taxation, where there are two methods of granting you tax relief. There is a concept called tax credit method. Under the tax credit method, both governments will take tax from you. India and New Zealand both will give, but one of them will give you credit. So against Indian tax liability, you can subtract what you paid in New Zealand, or against New Zealand tax liability, you can subtract what you paid in India. You will get tax in both countries. You will have to pay in both countries, but you can subtract the tax that you have paid in the other country. That is called tax credit method. Your tax liability is getting reduced now. Or alternatively, you can have something called tax exemption method, where any one country will take tax and the other country will completely forego. So in tax credit, both governments will take, but one will subtract what you paid in the other country. In tax exemption, one government will take, other government will not take only. These are the two methods. Normally, if there is any specific provision like long-term capital gain, so you have to follow that special rule. But here they make it clear that the provisions of DTAA are optional if the normal provisions of Income Tax Act are more beneficial. If the normal provisions of Income Tax Act are more beneficial, then you are allowed to opt for the normal provisions. If the normal provisions are beneficial, then you can pay tax as per normal provision. Next, other than DTAA, our government can enter, or we can have agreements between association. A specified association in India can have specified association agreement with specified association outside India. For example, ICAI does have agreement with ACC, where out of 13 papers, you have to give only 4 papers to get your ECCA degree once you have the CA degree. ICAI can have similar agreements with UKCMA or AICP, American Institute of Certified Public Accountants. They can have similar agreements also. In fact, Government of India can now have an agreement with a non-sovereign territory, something which is still under kingdom rule. That is also going to be allowed. So all kinds of agreements government can enter into, the main two objectives being: one, relief from double taxation; two, exchange of information so that government gets data about your foreign transaction. And for relief, we have two methods. We discussed them: tax credit and tax exemption method. It is now also clarified that if you are a resident of any third country, we will not let you do something called treaty shopping. For example, there is agreement between India and Germany, agreement between India, Germany, India, Germany, India, Germany. That means Indians and Germans should take benefit. Australians cannot take benefit of treaty between India and Germany. So what an Australian is doing, going to some rural Indian village and taking some small place on rent in a small village. With that, and that always remains locked, it is not used for any activity. With that place taken on rent, they get address proof of India. They have the leave and license agreement, the rental agreement. Now they tell everyone that we are from India. See this address, that small village in India. And they start taking benefit of their transactions done in Germany using the Indo-German agreement. So now we will not let you do that. This is known as treaty shopping. You have opened an office in India and done treaty shopping. You have done shopping of India-Germany treaty. Indirect benefit will now be provided. Treaty shopping arrangement is a situation where tax resident of one country where there is no treaty with the source country. For example, Australia had no treaty with Germany, avails relief by diverting income from other country, which is India, which has treaty with the residence country, maybe, Germany or Australia. So this misuse is now going to be prevented. Further, if you are resident of a foreign country and on the basis of that you are claiming relief, you are non-resident in India, therefore you are resident in some country outside India, and as per treaty, that country should get tax. That means India should leave tax, but only and only from that country if you bring a tax residency certificate. That country has to give us in writing that you have become a resident in that country, you have paid tax in that country, and therefore you will not be paying any tax in India. Next, we will also bring something called the non-discrimination clause here. We will not tax foreign assessees less favorable compared to domestic assessees. In other words, if I have to keep it simple for you, tax rate of non-resident will not be higher than tax rate of resident. Tax rate of non-resident will not be higher than tax rate of resident. If we are giving tax rate, a certain tax rate to resident, we will provide that benefit to non-resident also. The only exception being foreign company. In our country, foreign company ka tax rate is higher. I have written 35 here because it is an amendment. Foreign companies, till last year their tax rate was 40%. Now there is an amendment. Foreign company ka tax rate in India is 35% from this year onwards. It is an applicable amendment. In MAT chapter, I will discuss with you. So foreign company ka tax rate still higher. In India, domestic company ka tax rates are this: 30 and 25 are in the old regime, 22 and 15 are in the new regime. But this is not considered discrimination. In other words, for companies, we will levy the higher rate of tax. For companies, we will levy the higher rate of tax. The benefit is only for non-corporate assessing, non-discrimination. Ladies and gentlemen, maximum questions in DTAA chapter in exam come on unilateral relief. When there is no cooperation, when both governments do not have an agreement, then only Government of India will give you relief, provided you fulfill the following conditions. If you observe, there are 1, 2, 3, 4 conditions, but conditions 2, 3 and 4 are time pass. If there is one condition which is important, if there is one condition that you have to take home for the purpose of your exam, if there is one thing that matters, if there is one thing that is relevant, the only thing that you have to study is that the assessee has to be a resident, then only relief. See, understand why resident. Logic hai. If you are in amendment come revision, I may not be able to tell you the logic of everything. My normal lectures are based on the concept, on the philosophy. Nothing is bigger than logic. Logic se bada kuch bhi nahi hai. If you know the reason behind the provision, you will automatically be able to learn the law. But ये amendment का lecture है, ये revision का lecture है. यहाँ पे आप ये expect मत करो. Don't expect that मैं आपको हर एक चीज का logic बताऊंगा. मैं यहाँ पे हर एक चीज का logic नहीं बता सकता हूँ. नहीं तो you come and join my 200 hours lecture of CA final or 170 hours of CA inter. In the announcement itself, I told you that this year the amendments are so crazy, so massive that even crash courses are not good. Crash courses are only, time pass. I have, since the day the budget came, I have been telling students that please clear your exam, otherwise you will have to take the new lectures only. तो ये मैं आपको बहुत क्लियरली बोल रहा हूं that I am right now telling you the logic, but don't expect that I will be able to do it in all the concepts. A resident is going and earning interest in foreign country and bringing that money here. We are levying tax as per residence, home country, and that country has levied tax as per source, host country. So there is double taxation, juridical. Now, if there is treaty, we will give you relief as per treaty. But if there is no treaty, we can't do anything about that tax. Because you have brought foreign money to our country, we can at least grant you some relief in our country, and thus unilateral relief will be given only and only to residents. And if the main condition is that you have to be resident, obviously income has to be outside India. That country tax also you have to pay, and between India and that government there is no DTAA, because if there is DTAA, then I will take bilateral relief. No, then I don't need unilateral relief. When these two conditions happen, then only double taxation will happen. If this no DTAA has taken place, then only I want unilateral, otherwise I will go for bilateral. That means main condition is that I have to be a resident. What should be the calculation? First, compute the total income in India. The total income is going to include, do you understand, Indian plus foreign? Focus on these steps very carefully, because highest number of questions in exam are asked on this calculation. Total income. Calculate tax liability on the total. Apply the slabs. You take your old regime, new regime, apply the slabs, and find out something called average rate of tax, because India levies slab, no? So some income can go in 0, some in 5, some in 20, some in 30. Average rate. So how to find out average? Total tax, which you have calculated in step number 2, upon total income into 100. Average rate, simple. Total tax upon total income. In other words, your slab rates you have to convert into a flat rate. Total tax upon total income into 100. And then the question will always give you the tax that foreign country levied on that foreign income. So take tax rate in India or tax rate in foreign country. Either ka tax, udhar ka tax, whichever is lower. Tax here or tax there, whichever is lower. Take the lower of this average rate and this foreign rate. Rate of India, average rate, and rate of foreign country given in the question. Take whichever is lower and find out your relief. Doubly tax income, which is included in NTTI. So if you have taken any exemption or deduction against that income, so that much will not be eligible. Doubly tax income included in NTTI into the lower rate will be your relief. Subtract this relief from the tax that you have calculated here to get your final tax liability in India. To give you a small example, Mr. X is a resident who has Indian income of 8 lakh and foreign income of 7 lakh. In that country, there is no DTAA and Mr. X has paid tax of 20%. So what do? First, calculate total income, because if we don't give any relief, foreign income also is taxable because you are a resident. Then on this we are calculating tax as per 115 BAC, because there is no information about any exemption or deduction. We are applying new regime, and new regime at 15 lakh we have 140 plus cess. So 145,600. Average rate of tax becomes 9.71%. That is 145,600 divided by 15 lakh. Foreign rate is given to you at 20%. So you will get relief at Indian rate or foreign rate, Indian rate or foreign rate, Indian rate or foreign rate, whichever is lower. 9.71 will be your rate of relief. And finally, how are you going to calculate your relief? What is the doubly tax income? See, 15 lakh you have not paid double tax. You paid double tax only on 7 lakh. 8 lakh is taxable only in India. So that doubly tax income into the lower rate. Doubly tax income into the lower rate will give you your relief. And if in the exam they ask you final tax liability, this was your tax if there was no relief. But from this tax, when we have calculated your relief, this, ladies and gentlemen, will be your final tax liability. Doubly tax income included in NTTI into lower rate will be your relief. That relief you subtract from your tax calculator, and then you will get your final liability. Of course, This is liability. Then we adjust our prepaid taxes like TDS, TCS, etc., advance tax, which gives us payable or refundable. But this is how we will calculate our liability. And that, ladies and gentlemen, is your chapter, double taxation relief. Third and the last chapter that I will take up in this session, part number 1, lecture number 1 of revision cum amendment, again also applicable only for CA final students. Mode of acceptance and repayment of loan, advance and deposit, that is cash loan, people taking loans in cash, people having undisclosed income getting caught and claiming it to be a loan. So what does 269 SS say? 269 SS, you are not allowed to take or accept, that means we are talking about the borrower, any loan, advance or deposit other than the three allowable modes. The three allowable modes throughout the income tax law, they have used this: account pay check, account pay draft, electronic mode. Account pay check, account pay draft, electronic mode. Throughout the income tax law, they have mentioned these three modes. If you are taking loan, advance or deposit, you should be taking in these three modes only. If this amount plus any amount that you have taken in the past from the same party, if the total is becoming 20,000 or more with any person, if you are touching 20,000, then you should be taking that in the three allowable mode. If you touch cash in 20, then you will be liable for penalty. But following cases, this section is not applicable. Any loan, advance or deposit which is taken by these people or from these people, means any of the two parties is this: government company, statutory corporation, bank or any other notified institution, then this section is only not applicable. And if both parties, so here any one party has to be government or government company, but in the last point here, both the lender as well as borrower have to be farmers. If both of them are farmers, then again this section is not going to be applicable. If you have done violation, then 100% equivalent to the amount taken, that is 100% of the amount of loan, advance and deposit taken in violation, 100% is going to become your penalty. 100% of the amount of loan, advance or deposit that you have taken in violation is going to become your penalty. And whom it is going to be levied? On the person who has accepted that loan. That means the borrower will be paying the penalty if you have taken the loan in violation of 269 SS. Some case laws, most important being Supreme Court judgment Kumari A.B. Shanti, that in case there is reasonable cause, then penalty is not levied. We have a section 273B which we will discuss in penalties chapter. Any transaction between sister concerns, then we will not apply this penalty. If you use transfer bank vouchers, bank transfer vouchers, where it is not account pay check, account pay draft or online, but it is still through the bank, then there will be no penalty. When partners contribute money or withdraw money, that is capital and drawings, it is not loan, advance, deposit, we will not be levying any penalty. If there was genuine circumstance like you wanted cash discount on purchases, which is why you have taken a loan for an emergency, then again penalty will not be levied. If you have received share application money, so that is not a loan, advance or deposit, that is contribution towards share capital, penalty will not be levied. This one decision of Rajasthan High Court, that penalty will be levied on the excess over 20. For example, I take cash loan of 25. The Rajasthan High Court says that levy penalty of 5,000. But ICAI does not follow. ICAI levies 100 means 100%, 25,000 penalty. And of course, AO can either call it an unexplained cash credit, that is concealed income, or he can levy the loan penalty. AO can never levy both. See, if there is cash found with me, AO will ask me source. I tell him, sir, this is cash loan. So he has a choice to believe the story or not believe the story. If he believes my story, then he will levy cash loan penalty. Then he can't call it unexplained. Then he can't levy 68. And if he does not believe my story, then he can call it an undisclosed income, concealed income, levy this penalty. But then he can't levy this. Ultimately, he can levy only one. He cannot levy both penalties. Now, the loan that you have taken, obviously, you will have to repay also. So, at the time of repayment also, you have to be careful. If you are repaying any loan, advance or deposit, you have to repay in the same three modes: account pay check, account pay draft, electronic mode. Account pay check, account pay draft, electronic mode. If the amount of loan plus interest again is touching a total of 20,000 or more. So at the time of taking also, if it is touching 20 or more, at the time of repaying also, if it is touching 20,000 or more, then you have to take or repay in the three modes. Otherwise, 100% penalty will be levied. There also, here also. For property advance, when you are checking the total balance, check the total of all parties. Supposingly there are 5 buyers or 5 sellers and there is a joint transaction, then for outstanding balance you will be taking the total of all the parties. The exceptions here also are same. So government company, all that, bank, lender, borrower, both, farmers, same exception. And here also there is going to be flat penalty, 100% of the amount of loan, advance or deposit that is repaid in contravention. There it was loan, advance, deposit taken in contravention. Here it is repaid in contravention. There it was on the borrower who took it. Here also it is on the borrower only, because borrower only will repay. In other words, lender all in all is immune from levy of penalty under this chapter. Finally, there will be no cumulative penalty. If you take cash loan and you pay this penalty, same amount when you repay won't be penalized again. There won't be cumulative penalty on the same amount. And then last year a small amendment had taken place, that there are these two organizations, Primary Agriculture Credit Society, PACS, and Primary Cooperative Agriculture and Rural Development Bank, PACARD. PACS and PACARD, they have their members like any cooperative society. So there is PACS, Primary Agriculture Cooperative Society. There is PACARD, Primary Cooperative Agriculture and Rural Development Bank. They have their members. Now, whenever members will have surplus money, they will deposit. Some members have surplus money. They work as banks only, but they are not cooperative bank. They are not actually registered as banks. Their business is similar, but they are not bank. Because if they are bank, then 269 SS and 269 T is not applicable only. They are doing similar business. Members have surplus cash, they deposit here. And then there are other members who need money, so they give loans. So there are loan and deposit transactions between these members and these societies. So whenever there is a deposit accepted by these societies from its member, or a loan is given by these societies to their members, or when this loan or deposit is repaid. See, today we are taking deposit from our member. If we are taking this deposit from our member, one day we will have to repay it. Likewise, if we are giving loan to our member, one day member will repay. In all these transactions, these deposits, these loans and their repayment, the limit of 20,000 shall be increased to the limit of 2 lakh. For 269 SS and 269 T, normal limit is 20,000. But in these cases, the limit is going to be 2 lakh rupees. So that's your chapter of cash loans. So ladies and gentlemen, what or how is going to be these revision cum amendment lectures? Now that we have finished one lecture, I make it clear so that all final students understand or inter student understand. We will be having about 10 to 12 lectures of minimum 1 hour, maximum 1.5 hours. We are near 1.5 hours now and we are done with the lecture. Minimum 1 hour, maximum 1.5 hours. About 10 lectures. So roughly 12 to 15 hours mein all revision cum amendment lectures will get over. We are doing everything from the CA final textbook, handwritten book, the book with memes, and all the content of CA Inter is also covered here. So every time I start a new lecture, I am going to continue in the order. I am going to be doing everything that is in this book. As a CA final student, you have to watch the full lecture start to end. For the CA Inter students, whatever is the relevant part, I will cover. And at the end of the lecture, like I am doing now, that this becomes the end of your part 1. In today's first lecture of revision cum amendments, we have studied 3 chapters of CA final. Introduction, which covers tax rates, double taxation relief and cash loans. And out of whatever we have studied, for CA Inter students, the relevant part is the tax rate discussion that we have done. So this announcement I will make at the end of every lecture, that today we covered the following things for final and the following things for Inter, so that the Inter students know which part of the lecture they have to see. Whatever is applicable, only that part you have to see. And I am going to do this in every lecture. Do the lecture in the order of this book, and at the end of the lecture say we have finished the following things for final and following things will be applicable for Inter also. This we will be doing in every lecture. One thing, I believe now you are clear about this. Second thing, only the first lecture will be uploaded on YouTube. All other lectures will come only and only on the SS Pro Educare app. So you please make sure you download that app so that you get the access to all the lectures. Plus, I already told you in the announcement earlier that soon we are launching the advanced version of our app with extremely better and new features more and more user friendly. We will be calling it SS Pro Educare 2.0. Once that new app is available, we will be starting all the uploads on the new app. So once that new app is there, you can, all the new content will come in the new app. तो सर, तो क्या आपके दो ऐप रखने पड़ेंगे? Bro, Zomato and Blinkit belong to the same company, but you have both apps, no, in your phone. And you kindly delete a few apps. For example, Instagram, you delete till your exam. No value addition it is doing in your life. Yes, you will have to download both apps, SS Pro Educare and SS Pro Educare 2.0. If you think it is too much of load in your life, then delete both the apps and go to the Himalayas, settle down. No need to watch my lectures. Go learn from someone else. And plenty of people available to you. You want to learn from me, you have to learn as per my rules. Otherwise, thousands of people are learning from me and I am very happy and very content in life. You have to learn and clear your exams. You will have to follow my instructions. Otherwise, do what you want to, because even if I don't say it, you are still going to do what you want. Okay, so that becomes the end of our first lecture, and the announcement is we have completed introduction with tax rates, cash loans and double taxation relief for CA final students, and we have also completed tax rates applicable for CA intermediate students. This part they will have to watch, and second part of the announcement, all the subsequent lectures will come only and only under the SS Pro Educare app. Thank you very much. Have a nice day.